This conference will now be recorded.
Okay, so last time we were looking at our fraudulent companies, and we looked at this company that had these, for year one, had these transactions. They invested cash of $1 million to start the company. They made a fictitious sale for $10 million. Some of what was happening in those companies where they created revenue, reduced expenses. Then they borrowed some money from the bank. They paid themselves a salary. And with all of that revenue, they enticed Mr. Page to give his mother's $1 million to this company. Okay. So what I asked you all to do was, okay, if you have these 5 journal entries, can you prepare a trial balance? I made the journal entries. So let's go to the T accounts. In the first journal entry, we did what? Debit cash for $1 million. And we credited what? What would we have credited?
Common stock.
Yeah, common stock, if I can get to it over here. The credited common stock for $1 million. And what happened in the second journal entry?
You debited account. Oh, my bad.
And what do we credit?
Sales.
Then what happened in the next journal entry? Did we borrow $5 million?
You debited cash for $5 million, and then those payable was credited $5 million.
So it's nothing. So we're just posting the entries. And we'll make it a short-term note payable since they weren't buying equipment or anything. They were just making a short-term bank loan. And then what happened in the next transaction? They paid themselves some salary, correct? So they have a salary expense, $5 million. And they credit the cash $5 million, right? And then Jacob gave the company his mother's $1 million because he said this company is doing well. And what are they going to credit? What are we going to credit? Common stock again? Okay. So then I asked for a trial balance. So we did a trial balance. What's in the cash account? How much in the cash account?
1,000. No, that's wrong. My bad.
So how much is in the cash account? $2 million, I guess. 1 plus 5 plus 1 minus 5, is that 2 million?
That's $2 million.
Okay. Then we have account receivable. And that receivable is 10 million, correct? Then we had a note payable of 5 million. Short-term note payable. And we had common stock of how much?
$2 million?
$1 million.
Uh,
$2 million?
$1 million.
we got 2 million. We got the owner's original amount. Then we have the other that was
Are you doing
invested.
all of them?
Just
I
the
thought you was
first
doing
5.
just.
First 5.
Oh, okay, you told me first 4. I'm sorry.
Did I tell you the first 4? Oh,
Yes, sir.
okay.
So I only have the trial balance for the first 4.
Well, that's fine. So it'll be you want to do it just for the first 4? Okay. We'll do it for the first 4 since that's what we said. So we won't pick up that last. So our cash will only be $1 million if we leave that out. All right, sales.
It's 10 million. Is that 10 million?
And then we have what?
Salaries expense for 4 million.
So we just did the first 4, which is fine. So this is kind of how a fraudulent cutting would operate.
So for 5,
So if we total out the assets, how much do we have?
$15 million?
We're not missing anything, are we? And 5 million, 1 million, 10 million. This is 16. So what did we? I'll go back and look at these T accounts. So we said we were going to take this transaction out. Delete that one for now. And we're going to take this one out.
you're gonna do the first 5 or 4? Just so I
We're
can
just
put it
doing the
in.
first 4. So we're just doing the first 4.
Okay.
So that.
Okay.
So let's just see. So on our trial balance, we borrowed 5. We paid out 5. receivables, common stock. Okay, the salary expense was $4 million. So let me go back to the T accounts. $4 million. So the salary expense is $4 million. And that's gonna leave us that'll have $2 million here. So let's see if we can balance now. Are we balanced now?
Well, I had 16 million, I believe. Let me see. On both sides.
That's correct.
Okay.
So this is what the trial balance looks like with the first 4 transactions. And of course, there are other transactions, but these are, the transactions are gonna make a difference. So can we get an income statement?
$10 million.
You do 10 million in sales.
And the net sales is 10 million. So the gross profit is 10 million. So they always have other expenses, but these are the key ones we're looking at. And then we said the salary expense was what?
$4 million.
4 million.
Let's see if I can move these over. Okay, so salary expense, let me just clear the. It's 4 million. And so our total operating expenses are 4 million. And our net income is what?
$6 million.
6 million.
What's our statement of retained earnings going to look like?
Beginning RE is 0, net income is $6 million. I don't think we had no dividends.
Oh, yeah, retained earnings is what?
$6 million.
So this is what these companies were doing that you all were studying. And so when we look at the balance sheet, we got cash of what? 2 million. And what else do we have on the balance sheet? An account rate.
Account receivables.
And that was what? That was 10 million, right? Let me get this. Let's move this down. And so the total assets for this company is listed at 12 million. It has the note payable, and the amount of the note payable is what, 5 million? Common stock at this point, so this is 5 million. Common stock is 1 million. Retained earnings is what? 6 million. So our total move these lines over. So we add the notes payable, the common stock and retained earnings, we get what? 12 million. So this is a company that shows net income of 6 million, and they originally invested just $1 million in the company. They show a balance sheet, 12 million in assets, and they show total stockholders equity, 7 million, liabilities 5, so total liability owns equity 12 million. And they come to Jacob and they say, look at all the money we made on our investment. Give us that $1 million that your mother wants you to invest, and we will make you a lot of money. That's what they say. And remember, you aren't going to see the journal entries, audit to account, audit trial balance. The only thing people show you, the income statement, statement of retained earnings maybe, and the balance sheet. And they asked for $1 million, and they said, look at the return. If they earn 6 million on $1 million, what kind of return is that?
5 million.
So that's 600%, right? Whatever. So do you give them your $1 million?
Yes.
Okay, so Kayla says she gives them the $1 million. And so if you give them the $1 million, and then we go back to these other transactions, so we're going to move transaction 5 down here, so in the year 2. What's going to happen when these transactions are made in year 2? So in year 2, let's go to the They get your money in year 2. So this is year 1, this is year 2. So this is year 1, and this is year 2. Year 1 and year 2. And so in year 2, they get the $1 million that you gave them, and then they pay on this note payable. So we go back to journal entries. They get your $1 million. They pay $3 million on the note. So we go to the T accounts. $1 million comes in, and now the common stock gets the other $1 million now. This is year 2. Then they need to pay the bank. So they pay the bank $3 million. And when they pay the bank $3 million for that loan they got, how much cash do they have now? When we get to year 2, so this is how things are looking in year 1. And in year 2, once they get your $1 million and they pay the creditor, this is $3 million. We still got this account receivable on here for $10 million. The note payable, because they paid $3 million on it, it's going to be what, $2 million? So they paid on the note payable.
Notes payable, I think it's 3 million for year 2.
It's $3 million. It was 5, and how much did they pay on it? $2 million. Let's go back to that.
I see 3.
Yeah, they paid $3 million, so it should be $2 million left over.
Oh, okay.
So it's $2 million left on the note, and common stock is now what, $2 million. And got that other account, what, retained earnings? And the retained earnings account has what in it? It's $6 million. So now you have a company with no cash, a receivable for $10 million, and a note payable for $2 million, common stock $2 million, and retained earnings $6 million. I got it on the wrong line. So this is what happens when companies go bankrupt. They don't have any cash. So what are we gonna do? People, lying today is the way you can go now. You can tell a lie, lose an election by 10 million, say you won it. So these same people are gonna really be doing this stuff. So what can we do? What can we do so that Jacob won't be crying. Go to his mama crying. Oh, mama, I lost your $1 million. I'm sorry. What are we gonna do? Okay, let's put this down for a few minutes. That's what's called a statement of cash flow. And it has 3 parts to it: operating activities, investment activities, and financing activities. And we said when you start a company with cash, cash common stock, that's standard entry, the goal of the company is to increase the cash through earnings, revenues minus expenses. So we want the cash to go up. We want the cash to go up. But we don't want it up because we borrowed some money. We want it to go up because we had revenues that exceeded expenses. So cash has to go up. So revenue has to go up. Cash got to go up too. So anytime you got a company, so you can kind of see that now, if the revenue is going up, but the cash not going up, something is wrong. So
Professor,
yes,
sorry to interrupt, but this is Jennifer. I was just wondering if you got my email in regards to me leaving class early.
didn't have the time to read it today. But you know, if you got to leave, I treat everybody as a professional.
Okay.
So that's
All right.
fine.
All right. Thank you. Have a great night.
You too?
Thank you.
Okay. There are 3 parts to the statement of cash flow: operations, investments, and financing. Let's look at this for you as an individual. When you graduate, you want to make $1 million a year. You want to buy some new things. Okay, so you want to spend some of your money on buying you some new cars and everything. You want to pay off your student loans and have money left over. So you want salary to pay up to buy some new assets, and you want to pay off loans and have money left over. A business has to be able to do the same thing. A business needs cash from operations. It needs to expand, so it wants its investments to be negative because it's expanding its operations. It should be hopefully paying off debt, paying dividends, and still having cash left over. So that is what is supposed to happen, when we look at a company, the cash in it. So we have that statement of cash flow. And last semester, we learned how to do a statement of cash flow, right? And we'll change it up a little bit. But we always know that we said that in doing a cash statement of cash flow, operations needs to be positive. And if the cash in operation is not positive, then you got a problem. Didn't we say that? This can be negative and this can be negative, but if we start off here and we don't have a positive amount of operation, we got a problem. Let's go back to our example for a second and go back to the journal entries. If we looked at the journal entry, the first 4 journal entries, we said what? That we're doing statement of cash flow. If cash is involved, we included on the statement of cash flow. So we're going to include journal entry 1. Journal entry 2, we're not going to include it. So I'll put it in red because there's no cash involved. Okay, so that journal entry can't go on the statement of cash flow. This journal entry can, and this journal entry can, okay, on the statement of cash flow. So if we prepared a statement of cash flow, y'all got these 3 journal entries that are going on the statement of cash flow? You got them? You should have them.
Yeah.
Let's go to statement of cash flow. What we're going to do with the first journal entry?
We're gonna put it in section 3.
We're going to put it in section 3 for financing. So that first journal entry that we made, journal entry number 1, would be down here in cash flow. Let me just see. So same amount. Journal entry 1. So we put $1 million as a source of cash here. Okay. Now we're going to skip journal entry 2. What's journal entry 3?
Number 1, section 1, because it's a type 5.
Okay, so journal entry 2, we skip. Journal entry 3, what we're going to do?
Put it in section 1.
Okay, it's a loan, right?
Mm-hmm.
So here's journal entry 3. And they got a loan for how much?
5 million. The type go right there. It's a type 5, and then 5 million.
Let me put it right here, 5 million. So they got a loan for 5 million, a short-term loan for 5 million. So that's where the cash came from. What happened to journal entry 3?
Journal entry 4 is gonna be a salary expense, so it's gonna be in section 1, but it's gonna be on the use side.
On the use side. So that's going to be here, 4 million. So when we look at what we have in part 1, we have this working capital loan we got. We paid expenses of 4 million. So part 1 is only going to be showing $1 million. Okay. And part 2 nothing. Part 3 is showing $1 million. So our change in cash was 2 million. But when we go to an income statement, it said the net income was 6 million. So when you say net income of 6 million, we go to the statement of cash flow and operations and we only see $1 million. Where's the other money? Where's the other 5 million? So right away, you know something is wrong if the net income is 5 million, but you only got this much cash. So that's what you have to be able to look at. That's what you got to be able to look at and so this is the purpose of a statement of cash flow. The statement that we introduced briefly in Principles 1 and we worked on here. But when you have fraudulent companies, that statement is helpful because it's able to show you that even though the company said it had net income of such and such an amount, it It does not have the cash to go with that net income. So that's the thing that gets you looking. If you don't have cash in part one operations, the company has a problem. Let's go back to statement of cash flow in this example here where this is what we like to see in a company. Operations positive, investments negative, financing negative, but the change in cash flow positive. You had the company earned money, revenue minus expenses. It invested to expand. This is a good company. It paid off some bills, some liabilities owed, and it had cash left over. Now, when we got 4 or 5 journal entries, we can easily look at those journal entries. But if we had 1,000 journal entries, we couldn't do the statement of cash flow so easy by just looking at journal entries. So let's look at how we get a statement of cash flow when we have a lot of journal entries. Assets equal liabilities plus owner's equity, the standard equation. Assets equal liabilities plus common stock plus retained earnings. Cash plus the other assets equal liabilities plus common stock plus retained earnings. Same equation, we just add some things to it and we move it up some more. Cash equals the liabilities plus the common stock plus the retained earnings minus the other assets. So we move the other assets to the other side, move it a little bit more. Cash equals the current liabilities plus the long-term liabilities plus the common stock plus the retained earnings minus the current assets minus the long-term assets. A little bit more. Cash equals the current assets, current liabilities plus long-term liabilities plus the net income minus the dividends minus the current assets minus the long-term assets plus the contra accounts. And finally, the change in cash is equal to the change in everything else. So this is just an equation that we utilize to show that if we can look at the change in cash that we have, we don't have to go by those cash transactions. We can look at the change in all of the assets, all the other assets and liabilities, contra accounts and everything, and we can explain the change. If you go invest money, you gotta be able to understand this account, this statement, and how it's derived and what it's doing. If you can't, then you'll be like everybody else. When a company comes around and says, we made a lot of money, here's our income statement and balance sheet, and you will fall for, you won't be able to decipher. And so because this financial statement is different and hard to work with, a lot of time accounting majors and finance majors did not learn how to do this, what the statement of cash flow meant. So when the person came to them with the income, that caused the problem. So moving along a little bit further, we're going to look at the change in all of these other accounts, and we're going to put it in a certain part of the cash flow statement. Remember, there's operations, investments, financing, and the change in cash flow. And the key place that we need cash to be is in operations. We need it here in terms of the change in cash flow. So we need to determine now, if we're looking at all of these changes down here, where all of these changes go. Okay. Current liabilities Anything current is going to be, it's going to be in part one. Okay, so it's going to be part one. Okay. And so in part one is operations. Okay. When we have a long-term liabilities, that's going to go in part three of the statement. So now we're just saying where the changes are going to go. Common stock is going to be in part three. When there's a change in common stock, it's going to be in part three, financing. Net income is going to be in operations. So it's going to be in part one, operations. Dividends is always going to be in part three. We have a change in dividends. It's in parts three, financing. Current assets are going to be in part one, operations. Long-term assets are going to be in part two, which is the investing part. Contra assets are typically going to be in part one, which is operations. So all I've shown here is that change in cash comes from the change in all of these items. Now we have to see which changes are going to be in operations, which changes are going to be in financing, and which changes are going to be in investing. Then we get into, is it a source of cash or is it a use of cash? If a current liability goes up, if it increases, it's a source of cash. So if the current liability increase, it's a source of cash. When you get a student loan, what happens in your cash account? It goes up. If the current liability goes down, it becomes a decrease in operations. Long-term liabilities are going to operate the same way. They're in part three, but if they go up, they're a source. If they go down, they're a decrease. Let me go down there. And common stock's going to be the same way. If they increase their source of cash, if they decrease their use of cash. On net income, if you have an increase in income, it's a source. But if you have a decrease, that is, you had a loss, it's a use. Dividends are always going to be a use. They're going to increase, but they're going to be a use. Current assets are going to operate just the opposite. If they go up, if they increase, they're going to be a use. That is, when you buy your cell phone, your cash goes down. Same thing with long-term assets. If they increase, it's a use. And if they decrease, then it's a source. So they're operating just the opposite. And we'll look at an example. But this is a statement that people didn't learn how to use. And so this is why they have problems. Contra accounts are going to be just the opposite. If they increase their source, and if they decrease, they will be in use. Okay, so we got this table here. We got this table. And if you did not have this template, it'd be hard to do that statement. But because I, in my spare time, created this template, we just have to work to fill it in. So let's look at our example here. And what has to happen is, if you have a set of financial statements, there actually will be a statement of cash flow with it if you ask for it. But if you don't ask for it, you don't look at it, then you can't investigate the company. So if you can just stop and look at this, or you can stop and do a source of cash flow. So what we're going to do, we're going to stop here, and we'll go back over all of this next time. So we'll push back everything, since we didn't get to that point. So even though I put things in, if I don't think we're ready to go to those, we won't do that. But your job next time is to go through this statement of cash flow and read this material, realizing that if you don't learn how to use a statement of cash flow, you're never going to be able to invest any money, because you got to be able to see if the company had cash in operations, did it spend money in investments, did it pay off bills. Now, where are we going with this? Once we learn how to do these statements, any company that you might want to work for, you want to invest money in, you need to look at a statement of cash flow. So everybody's going to pick one company. They're going to Google the cash flow statement for that company. You don't have to make them. And then you go indicate whether you would invest $1 million or not. Now we're trying to learn, so we're not going to use eBay, Apple, who else? Microsoft, companies like that. Companies that you might plan to work for or buy something from, companies in Houston area and everything that are publicly traded, are there, statements are there. You're going to go in and look at their cash flow statements and see if you're going to give them $1 million. So that's one thing we're going to do. Then we have some homework problems that we probably will push back to 2. So we just push everything back, where your team is going to do a statement of cash flow, going to prepare a statement of cash flow. So we will review this information next time. We'll go through an example to show you how to calculate a statement of cash flow. because you're doing it from a template that I prepare, you simply fill out the template to look at sections 1, 2, and 3. And your goal is to see if that company is having cash flow and operations positive, minus an investment, minus in financing, and an overall increase in cash. So that's where we're going.